Welcome, you're watching the Mutual Fund Show. I'm Tamana Inamdar. This is the show where we talk about how mutual fund investments can help you achieve your financial goals and secure your future. Now, the topic we're talking about today, I would assume is relevant to pretty much every family. The cost of higher education is something which has been rising consistently over the last 20 years. Along with the costs are also the aspirations of where the next generation studies, what they do with their future. Now, whether you're saving for a child's future in terms of education, their plans, their wedding, whatever it is, one of the most important financial aspects is how to achieve those goals. Is it enough to just save one little portion every month? How can you use mutual funds to maximize those goals while being safe in your investments? Because obviously it is for such a basic need, and that's what we're going to talk about today. In fact, we'll talk about some of the top funds available for this purpose and whether you should look at specific funds for wealth creation, for education, or for children's future, or you should have a broader based attitude and outlook towards these investments. To discuss this in detail, I'm speaking now with Varun Fatehpuria of Daulat Wealth Management. In a bit, we'll be talking with Himanshu Kohli as well of Client Associates. Welcome to the show. Varun, let me begin, with sort of your take of whether this is a good instrument, because perhaps one of the first questions in the minds of viewers right now would be that, is it risky to put the money I set aside for my child's future in instruments like mutual funds?
So, hi, Tamana. Good afternoon. Thank you for having me on this show. So, as you correctly pointed out, obviously, I think saving up a substantial amount of kitty for your child's education requires a certain amount of dedication. And it only becomes easier if you start early, because you need to save a significantly smaller sum of money, given the time horizon in front of you that you have, right? So one of the things that we typically tend to observe is that parents want to have a substantially higher amount of allocation to debt, at least in the early days of their investment, primarily due to how precious this goal is for parents. They obviously want the capital to be protected and do not want to get caught in a cycle where even after having saved for a certain amount of years, they're not able to meet and send their child for their education, either domestically or abroad. So we feel that you should obviously look at MF as an asset class, as a product, if you have that time horizon in your hand, to build that corpus, whether you are looking at a 5-year, 10-year, 15-year, or 20-year time horizon in front of you. MF definitely is a regulated asset class. It provides you a sufficiently diversified amount of portfolio. And even if you look at the returns that a well-diversified mutual fund portfolio has delivered in the range of 12 to 15%, you should be able to reach that goal that you have in mind, obviously accounting for the inflation and the currency depreciation over a 10-year or 15-year time horizon.
Very important question to ask, Varun, is that should you go in for a product which is focused for this purpose, which is a fund to create wealth for children's education, etc. Because remember, AUMs mutual fund companies, AMCs, very often have these kind of products. They're very popular, but do they really work? So there's some data which has been pulled out by my colleague Chinmay, and we'll just put that out for our viewers. These are the top performing children fund schemes. We've picked 5-year returns first. So the Tata Young Citizens tops the list, 5-year returns of 22%, followed by the UTI Children's Equity Fund, 20.8%, HDFC Children's Gift Fund, 20.3%. There's an ICICI Approved Child Care Fund at 18.7%. If you go on to that, there's an AB Sun Life Bal Bhavishya Fund, 16.3% returns, LIC Mutual Fund Children's Fund, 15.4%, Axis Children's Gift Fund at 14.4%, and SBI Children's Benefit Fund at 14.1%. Now, these are the 5-year returns. If I expand that time horizon and look at 10-year returns, frankly, I don't know if this is really looking impressive. HDFC Children's Gift Fund tops that list, has given 14.6% over 10 years. The UTI Children's Equity Fund has given 13.8%. Tata Young Citizens Fund has given 13.3%. The ICICI Approved Childcare has given 12.6%. And you go all the way down to the UTI Children's Hybrid Fund, which has given 9.7%. The LIC Mutual Fund Children's Fund is 9.9%, and the SBI Magnum is about 12.1%. Varun, you know, just first glance looking at this and this fabulous data that our team has pulled out, one would wonder whether I should go for any of these funds. I could go for a flexi cap, large cap fund, a Nifty ETF, and definitely get better returns than these. Is that fair to say?
So absolutely, Tamana. Obviously, I think all of these funds that you have mentioned falls under the solution-oriented categories which mutual fund companies have created, right? And these schemes have a minimum lock-in period of 5 years, or when the child attains majority, whichever is earlier. Even if you just go by the returns, obviously the returns have not been anything to talk home about, and we are always a big advocate of creating a more well-diversified portfolio across large cap, mid cap, small cap, depending on what the market conditions are, because if you look at the past data, the returns of a more well-diversified portfolio handsomely tends to beat the numbers that we can see on the screen. The only thing I think why people tend to gravitate towards this, and this is more psychologically, because it allows them to bucket their goals. So they know that they have this children's fund that they have invested in, and this is earmarked for the child's education or marriage or
just 1 minute.
whatever that
Varun,
goal
just
is.
1 minute. You mentioned that this helps them to psychologically buffer their goals. They already know that every parent knows they want to save for their child. So that psychological buffer is not really required. I would ask the question that should our viewers stay away from these kind of solution-oriented funds and actually look at returns? Just because something is labeled a children's fund doesn't mean it's going to give you good returns.
Absolutely, so the reason that I mentioned that is, let's say if you have already an existing mutual fund portfolio, and once you see a children's fund, you automatically know that this is the money that you have sidelined for your child, right? But obviously, we advocate that go about creating a more diversified mutual fund portfolio across categories, across sectors, and in all likelihood, that will end up giving you a higher return than what these funds have been able to deliver in the past.
Okay, so then let's start from scratch. At different stages, you might decide to start saving for your child's future. I mean, best time would be as soon as they are born. But okay, young child, and you're looking at a time horizon of say 15 years, aiming for higher education, 15 to 20 years. What would be the blueprint of a perfect portfolio focused on building a corpus for the child's future?
So one of the first thing that we need to have in our mind is the cost of the education, whether you want to save for an education for your child domestically, or if you want to send them abroad for a higher education, right? So we need to have what is the current fee structure today in mind for a 3-year or a 4-year undergraduate period, right? And then we need to take into account inflation if you're sending your child domestically, but also need to add currency depreciation relative to the currency, relative to the country that you want to send your child to. So that could be the US dollar, that could be the euro, that could be the pound, or whatever that is. So we need to take that into calculation as well. And once we add both of these numbers, an inflation of 4 to 5% and a currency depreciation of 3 to 4%, which is roughly what has been the historical average against the US dollar and the euro over the past 5 to 10 years. Once we add these numbers into mind and then accordingly formulate and project numbers 15 years or 18 years down the line, then we can see the amount of money that we would require at that point in time. And then accordingly, we can do a back calculation with respect to what is the SIP that you would require to do on a monthly basis to be able to reach your goal in the next 10 years, 15 years, whatever your time horizon is. So that is what we recommend, is take both the currency depreciation if you're looking to send your child abroad and the inflation itself, because obviously both of these things over a 10-year, 15-year period significantly adds to the amount that you would require. And once you have the goal amount that you need to reach in a specific number of years, then you can accordingly see, based on a projected 12%, 15% rate of return, what is the SIP amount that you will need to do on a monthly basis.
Okay, so let me just put this into perspective. Suppose you have, the best case, like I said, Varun, is you start planning when the child is just born or young enough, going to school, etc. What about people who haven't quite done that? and say the child is 8, 10 or whatever years old and you're looking forward. Now, how do you start at that point? Do you need to get a little more aggressive because you have a shorter time horizon for when you need the money?
So, Tamana, what I would say is that obviously, if you're starting really early, you have that benefit of time in front of you. There is something you could get extremely aggressive with having a definitely higher proportion of your assets towards risk assets like equities, which has the potential to create long-term wealth, right? But let's say, what if you have a relatively shorter time horizon of 5 year, 7 year, 8 year time period? At that point in time, having let's say an 80-90% exposure to equity could not be possibly a very good idea. So what we suggest is create a more balanced portfolio of about 50-50 to equity or a debt. Equity portion typically can be headlined with a balanced advantage fund or a multi-asset fund, which basically provides you that downside protection, which let's say a more riskier, a mid cap or a small cap segment will not be able to do in a 5 year, 7 year period. So if you're having a shorter time horizon, obviously go for a more balanced portfolio. But obviously, on the flip side, then is that you need to invest a slightly higher amount of money than what you would have if you would have started investing earlier into equities.
You know, so one of the things that we're talking about on what to keep in mind is the tax incentive you get if you invest in children's mutual funds. Now, just to get some detail on this, Varun, I have to get this tax benefit of 1.5 lakhs under Section 80C, invest only in earmarked funds for the children's future. It cannot be the money that I may have invested for their future, but in other funds.
That is correct. So these are the solution-oriented categories, the children mutual funds. You need to be able to invest only in them to get that 1.5 lakh rupees tax deduction under ATC, assuming that you have not already maxed out on your contributions over there, which could include a PPF, so on and so forth. So you need to, yes, definitely just invest in a specific category of mutual funds. That could be a solution-oriented fund, but let's say even an equity linked savings schemes, which comes with a 3 year lock-in, but provides you that tax benefit as well.
Okay. Himanshu, Kohli is also joining us in on the conversation. Himanshu, great to have you on the show as well. Let's, start with your take on from day zero. Suppose you have to build a fund from day zero for your child with a 15-year horizon. What is the blueprint that you would suggest?
So first of all, I would like to see what would be the expense of the education, let's say. So let's say 15 years down the line, I have to send a kid for higher education. Let's assume this is a decent college in US. Now, over there, if I look at today, I need to invest $75,000 per annum, and it's a 4 year education. So in all, I need to spend about $300,000 today's value over next 4 years. But if this expense is to happen over 15 years, 16 years, 17 years, 18 years, one, the value of the dollar will go up. Let's assume dollar will appreciate 3% versus rupee. And also the university cost will also increase by 3% per annum over at that point in time. Now, over here, if I have, let's say, next 15 years to save and then spend this money over next 4 years, today I need to start with an SIP amount, which could be about a lakh rupees. In case my portfolio can compound at 14%. And I would say also 14% is coming because there is a risk profile, which I'm assuming it's a long term. Someone can easily park the money into more multi-cap funds or mid and small cap funds and is willing to take some volatility in the short term. If this horizon is, let's say, again similar, but one is wants to reduce the volatility, one can go for a large cap fund which can give a compounded rate of return of 12%. Or someone wants to even further be safe, then go for a hybrid fund which can compound at 10% per annum. So over here, if I just look at these three scenarios, the amount which is required uh, could be 1 lakh rupees, it could be 1 lakh 35,000, or it could be 1 lakh 80,000, depending on whether I'm compounding the money at 14%, 12%, or 10%. And there also, I would say it's actually good to go with a combination. maybe first 5 years, I can just do uh, slightly riskier funds, which could be mid cap or small caps. Start with 1 lakh rupees, increase it by 10,000 rupees per annum. So next year I start saving 1 lakh 10,000, then next year 1 lakh 20,000, go up to 1 lakh 50,000. Then start with a large cap fund at 1 lakh 50,000 and then increase it by 10,000 rupees per annum. And then go to a balanced fund and start with maybe 2 lakh rupees and then increase it by 10,000 per annum. I will be able to comfortably meet this cost of education, which could be over a period of time cost me somewhere about 6.5 to 7 crore rupees. Now that is something which is the best way to look at some of these education plans. And so I give you an example of overseas education. Similarly, if this needs to be done within India, maybe the cost of education today is, let's assume, 20 lakh rupees per annum, and I need to provide for this. So maybe one needs to then vary this amount, do a smaller amount of SIPs, or maybe take a smaller or less volatile exposure. So it totally depends on a situation to situation, but this is something which is one of the most important aspect, which is kids' education, where people want to provide for the best
Yeah.
and then build this up gradually over a period of time.
So what is your take, Himanshu, on the products that are available right now, solution-oriented funds that are marketed as those specifically for this purpose? Should an investor who's looking to build this corpus look at these funds, or independently look at, you know, a healthy mix of various sectors, large cap, small cap, index, etc.?
So I would say I am not too fond of this specific funds which are marketed for the particular objective, though they can appeal very well to an investor or someone who is going to use it. But idea is to select the best funds in each asset class. So let's say large cap, someone wants to do it, maybe do a combination of index or one or two large cap active managers. Someone wants to do it in mid cap or small cap, maybe go with one or two very good active managers over there. Rather than focusing on these particular schemes which are being marketed, let's say LIC mutual fund, children's fund. Maybe last 5 years compounding return is good, but last 5 years compounding returns of some of the other funds also will be equally good or even better than this. So I would not want to compromise on the quality of the manager, quality of the scheme, quality of the fund. I need to see the expense ratios of each one of these also. And yes, create a discipline. So maybe I would rather hire an advisor who can help me bring that discipline of regular saving, increasing it year after year, seeing where my goal is and where am I today. Every 3 years, 5 years, where am I? How far am I from the goal? Do I need to change the path? Do I need to rebalance? Now, those are some of the things which are very, very handy over there. So rather than looking at some of these particular schemes, which one can look at it also, but preferred route would be not to go with the marketing gimmick of these schemes. Better would be to look at the asset allocation and then choose the best products within those asset classes.
So what would be, I'm going to ask this to Varun as well, what would be your top 2 or 3 funds that people should look at for this purpose? And I'll start
So I
with you, Himanshu.
So I would say large cap, one can look at an index, or one could look at maybe something like ICICI Prudential or Mire. Those schemes are fairly good. Uh, in fact, some of these schemes which are being shown on the screen, they could also be looked at, but they would not be my first preference in any case. So in case of multi-cap, one can go with a solid manager like Kotak, or maybe one can look at in mid and small cap, maybe Kotak or Nippon. They are very healthy schemes. They have a track record. Their expense ratios are far under control. And one just needs to create a combination. And then hybrid, one can go with ICICI or HDFC, which are very standard offerings. They have a great track record, and one can just build up the portfolio through those also. So I would say choosing the funds is something which an advisor can do it for you. Also, how much to save on a monthly basis or yearly basis, and you need to increase the amount on a yearly basis, that can be done through an advisor. Pay them small fees to help you look at the amount and the selection of the schemes, and just do a periodic review, whether a yearly or once in 3 years, in terms of how far are you from the goal and you need to rebalance something or reallocate something, or if some inflation figures have come into picture, one needs to take into account those things, or if there is a change in tax aspects at that point in time. Let's say tomorrow mutual funds becomes fully taxable as marginal tax rate. Maybe one needs to then increase the size or quantum of investments
Yeah,
also.
yeah.
So those periodic reviews are very, very important.
Right.
That is what I would recommend.
Varun, that question for you. What are the top 2 or 3 funds you'd recommend for this purpose?
So I would allude to what a lot of Himanshu has just said. If you're looking at a large cap allocation, maybe investors could look at a combination of an index fund like a Nifty 50, but also a flexi cap fund like a Parag Parikh Flexi Fund. Or if you're looking at just pure play large cap funds, then an ICICI Blue Chip or a Nippon India large cap fund is a good pick on the large cap category. If you're looking at a mid and the small cap segment today, mid Motilal Oswal mid cap fund is a good pick over there. A Kotak Emerging Equity Fund is a good pick over there. If you're looking at the small cap segment, SBI small cap fund really stands out for its focus on downside protection. So these are some of the top picks that we have across the category. Obviously, that comes with the caveat that investors need to have what sort of an allocation they need to have across all of these 3 different market cap segments, depending on what the market conditions are today. So if I'm constructing the portfolio today, obviously it would be constructed with a predominantly large cap bias of about 65 to 70%, and the remaining into the small and mid cap segment, given the run up that we have seen.
All right, let's get to the part of the show where we take our viewer queries and get our experts to answer them. Remember, the number where you can send your query in on WhatsApp is on the screen. All right, Puneet, age 35, writes in, says, I seek long-term wealth creation for child's marriage, education and retirement. I assume his own retirement. Please review my portfolio. My time horizon is 20 years. He's also given his portfolio includes Axis Small Cap, 10,000 rupees a month, Quant Small Cap, 10,000 rupees a month, Nippon also Small Cap at 10K a month, Kotak Mid Cap and Parag Flexi Cap at 10K per month. Himanshu, I'll come to you first. First of all, one set of investments for 3 different purposes, does that make sense?
I would say if the time horizon is 20 years, then yes, one can look at that. Or one could also prioritize this, Tamanna, that this is something which is absolutely I will not compromise on. Let's say my retirement expenses, I have to spend this much money to keep myself going on a monthly basis, today's value. And with inflation adjusted, what would be that value 20 years from now? Similarly, child's education could be another area where I don't want to compromise. Maybe I can look at a bit of a compromise on the marriage expenses, but maybe in the priority, retirement planning is number 1, child's education is number 2, or third could be marriage, or in someone else's cases, it could be the other way around also. But I would say Puneet has first of all put across the very clearly 20 years time horizon, 35 years of age, and he has actually made a SIP plan for 10,000 rupees each in 5 of the schemes. So I am seeing 80% of the investments are in mid and small cap over here, and 20% investment is in a flexi cap, and all 5 funds, I think they are fairly decent funds over here. Now, if I assume these funds can compound the money at 14 to 15%, in 20 years, this 50,000 rupees SIP amount will be somewhere closer to 6.5 crore rupees, Tamanna. 6.5 crore rupees. And if I further create the present value of this 6.5 crores, today's value, if I discount it by, let's say, an inflation of 6%, there will be roughly about 2 crore rupees of corpus which is being created through this process. Now, one needs to figure out how much do I need for my retirement today. Let's say if it's maybe 80 lakh rupees. I want to be very, very sure about this. I want to maybe focus more on flexi cap fund or a large cap fund over there.
Right.
Education, maybe I can be focused between flexi cap and mid and small cap. And if marriage is the third priority over there, maybe I want to take a slightly more risk, and I'm happy with the maybe more of a mid and small cap exposure.
Okay.
So if I just put these 3 buckets, maybe 30 to 40% could be large cap exposure, 30 to 40% could be mid and small cap exposure, and 30 to 40% could be flexi cap exposure. That is the way I would recommend him. But I must compliment. I think what Puneet has actually done is a very good plan, and 20 years is a long-term horizon.
Yeah.
240 installments. SIP, you are averaging the value of investment. So even if you are there with the small cap fund, I'm not too much bothered about it because what time horizon will take care of the volatility, and the process which he has followed is absolutely fantastic.
Excellent,
It is some,
excellent. Well done, Puneet. All right, let's just take one more question very quickly before we end the show. Dasari Nagraj writes in, says, I started investment in 2018 with HDFC Hybrid Equity Fund. I have a target of 1 crore rupees in 10 years. And then he goes on to describe his portfolio. Says, should I continue with these funds or should I make corrections? Varun, this question's for you. Those allocations are on your screen. Does this really add up to a 1 crore figure in the time horizon they have, which is 10 years?
So again, if I just look at the allocation today, I mean, we'll have to still do the numbers, but today, if you're just looking at one of the things that investors typically tend to do is obviously pile on to more the mid and the small cap segment when it has run up extremely in the last 3 to 4 years. So the allocation that you have to those segments is something that you need to basically tinker upon depending on where you see the market conditions. So maybe as things stand today, we'll probably like to prune that exposure a bit and increase the exposure to large and small cap segments. But one thing, obviously, that his portfolio standouts is that it has a significantly, or let's say 100% exposure to equity funds, right? Maybe in some form, they have a debt exposure to a hybrid equity fund as well. So that is where it stands out. For a 8 to 10 year horizon, the allocation that you have to equity is significantly higher. And even if that we assume that they are able to compound at 13 to 15%, then basically the investor should be able to reach that amount in 10 years down the line.
Okay. So you will have to tweak it a little bit. All right, that's all the time we have. Thank you so much, Varun and Himanshu, for joining in on the show today. The number's on your screen if you want to reach out to us. But for now, that's all the time we have on the Mutual Fund Show. Thank you for joining us, but stay tuned. A lot more coming up on the other side.